Hello, welcome to our Advanced Markets Educational Series. I am your host, Matt Erpelding, Director of Advanced Markets here at Ash Brokerage. Today, we are going to talk about a business-funded retirement plan specifically for the owners of pass-through entities like S-Corps, LLCs, and Partnerships. Our life audit team recently reviewed a policy for the owner of a closely held business. They found the policy to be performing well and recommended to continue funding it, assuming the purpose of the coverage was still relevant. To make sure the policy was meeting the owner's needs, the advisor asked me to speak with his client. So, we talked about a few things, then asked why he originally bought the policy, and his answer was very compelling. The business owner told me that the 401k plan he set up for his company didn't allow him to contribute as much as he needed to reach his retirement saving goals. To him, the life insurance policy was an additional form of retirement savings funded by his business. What he liked most about this plan was the government wasn't telling him how much he could put away or how old he had to be to take money out. He also loved that he could use money earned from the business to fund his personal retirement needs without having to make contributions to employee accounts. Let's stop there. In most case studies, you hear about everything was wrong and we helped to fix it. In this case, however, the client was already doing everything right and for the right reasons. I love this story because it proves not only that solution works, but also that there are business owners out there who want to save more for retirement and see the value in using life insurance to do so. What is at stake? When it comes to saving for retirement, the rules on qualified plans put high-income business owners at a real disadvantage. The law limits how much pre-tax income anyone can contribute to a qualified plan, and in an employer-sponsored plan like a 401k, those with the highest incomes are further limited depending on the level of contributions from rank-and-file employees. For owners of successful businesses whose income includes substantial profit distributions, the amount of total income that can be put into a qualified retirement plan is far too small to get the job done. If they relied solely on the qualified plan assets and Social Security for retirement income, they would end up trying to make do on just 50% of their pre-retirement income or less. To meet their retirement income goals, high-income business owners need to put away much more than they can get into their qualified plans, and they want to do so as cost-effectively and tax-efficiently as possible. That's where we can help. Does the perfect retirement plan exist? From the business owner's perspective, an ideal plan would have 3 characteristics. First, plan contributions would be deductible, and account values would grow tax-deferred. Second, the plan would allow contributions to be as large as the owner desired. Third, it would be discriminatory, which means contributions could be primarily or exclusively for the business owner's benefit, excluding most or all employees from participating in the plan. However, Congress has made it impossible for owners of pass-through entities to legally build a plan that delivers all 3 of those characteristics. But a business owner can have an account that delivers 2 of 3, more generous contribution limits and discriminatory. And even though it won't be tax deductible on the front end, it will grow tax deferred and may even be a source of tax-free income in retirement. Qualified plans are tax deductible and tax deferred, but have contribution limits and require all eligible employees to be included in the plan. Non-qualified deferred compensation plans work well for highly paid non-owner employees because they have no contribution limits and allow the owner to pick and choose who to include in the plan. However, for the owner, any W-2 income deferred increases the company's taxable profit by the same amount, which effectively eliminates any tax advantage. Most deferred compensation plans also require at least some government reporting. Is there a way to get around these obstacles? What if you could create a plan that offers more generous contribution limits than a traditional retirement plan, grows tax deferred, provides tax-free income with no age limitations, and even provides a mortality hedge? Would you be interested in such a plan? The business owner's business-funded retirement strategy uses life insurance to provide these benefits and more. There are no penalties for accessing the funds before age 59 and a half. There are no required minimum distributions at age 70 and a half. It's completely private with no government reporting requirements. It's controlled by the business owner with no third-party custodian required. It can be part of legacy planning as any remaining assets pass to their heirs with basis step-up. It's self-completing. If the owner dies before retirement, the beneficiaries receive an income tax-free death benefit. There are no restrictions on pledging account value as debt security. And there's possibility enhanced creditor protection relative to bank accounts or investment accounts. Let's take a closer look at how it works. The vehicle, or as we sometimes say, the wrapper, for the business-funded retirement strategy is a cash value life insurance policy insuring the business owner. The policy is personally owned, or perhaps owned inside a revocable trust, and the beneficiaries are the business owner's spouse and children. The corporate checking account is used to send premiums directly to the insurance company, with the premium amount being included in the owner's W-2 income or allocated to the owner's K-1 income. In the case discussed earlier, the business owner was writing a check with his business checking account to pay for his personally owned life insurance policy. He made sure the CPA reported the payment as compensation on his taxes. Who is an ideal candidate for a business owner's business-funded retirement plan? This plan is specific to owners of closely held businesses with pass-through taxation. In other words, businesses other than C Corps. The ideal client is the owner of a very successful business consistently generating large profits. Look for business owners between the age of 45 and 55, or someone at least 10 years away from retirement. You want to especially look for an owner who takes significant income from the business but lives a modest lifestyle. Why? Because they understand the importance of saving and they have the means to make the solution work. A great candidate is someone who hates to pay taxes, doesn't like government rules and restrictions on his property, values privacy and control, and is frustrated with having to pay for employees' retirement plans. With that description, who comes to mind? You probably know a few business owners who fit this profile. Thank you for engaging in our session today. I hope you found this investment of your time to be productive. Please invest 5 to 10 more minutes to think about clients who would benefit from this strategy. Write down their names. Then call us to discuss this opportunity. Because whatever the question, whatever the need, Ash answers.